Hello, my name is Wesley, and I'm back with another video. I want to tell you I've been gone for about a little while. I had some issues I had to personal business I had to take care of, and so I am back. And I want to thank each and every one of you all for sticking with me and still watching these videos. Today, this is a timely video. Now, this video is about the bear market. Now, the bear, what you see in front of you, bear is sleeping. He's not gone. There's a big difference between sleeping and gone. The thing here is, it may appear that they're the same. They're not the same. And stick with me in this video. I'm going to show you why I think the bear is sleeping. Now, I'm your host, Wesley. This is Investing in Rhythm. We run a portfolio called the Cross Method. And the Cross Method, I'm telling you, is killing it. If you want to know more about the Cross Method, shoot me a line down there below and say, hey, what is that Cross Method all about? I'll be glad to show you. Now, stick with me. I'm going to show you something. Now, I'm going to show you a chart here. Now, this chart right here, which is in front of you, is the 20-year Treasury. Now, what's interesting about the 20-year Treasury is that this is the psychology of the market. It's different from timing. This is the psychology of the market. Now stick with me. I'm going to show you what I'm talking about. Now, what you see in front of you, you see the 50-day moving line. This is the purple line. Now, the 20-year Treasury is the red line. Now, this is what it means. When you see it falling, what that means is the Fed is tightening. It's tightening interest rates. Not only is he tightening interest rates, is that the market believes that it's going to be a tightening cycle that's going to last a while. Now, the Fed can be tightening, but the 10-year Treasury does not believe it. And what happens is the 2-year and the 10-year start selling off while the Fed is still tightening interest rates. What that means is that the 10-year Treasury, the 20-year Treasury, believes that the Fed is making a mistake and that the Fed is going to turn back around. That's what it means when it's falling. Okay. Now you see right here, this is on June 13, 22. Now you see it stopped falling and it started rising. Now when it starts to rise, okay, the stock market responds. The stock market responds. What that means is that even though that the Fed is raising rates still, the market is saying that we believe that the Fed is wrong and that soon he's going to be stopping or he's going to be reversing. So you get this move up, right? But this could be a relief rally, a fake out. We don't know. But then look what happened here. It started falling again, right? So the Fed came out and reiterated that he's going to keep tightening until he kills inflation. So then what? The 20-year Treasury starts to sell off. You see that? So the market is saying we believe the Fed here. But see right here, this bottom, then it went up, then made another double bottom. See, that right there was the telltale sign that we are in the phase that the market does not believe the Fed. See, and you start getting this rise. That's why the stock market is rising. Then you got this little pullback. That's fine. As long as we don't break this level right here that we made on November 7th, year 2022. As long as we don't break that. You see that? So you're going to get some ups and downs. But this is a key level to watch. Now look right here. Now we went up and we made a top. We came back down. Look, came back down. Then we tried to come back above it. See, we didn't break back above this level. That's key right here. See, that's key right here. See, we don't have nothing like this that's similar. So what this means is this is different right here. So what it means right now is that this could be a fake out. If this 20-year Treasury can't get above 108 or above 110, then this could be waking up the bear time. You see, so right now, this is a kind of telltale sign, a psychology. It's not a market timing thing where you allocate money. What this is kind of like something that you should take heed of. Okay, walk carefully. This is what this means. Okay, now we're gonna move more into a timing, money allocation part of the stock market. Now stick with me. Now we're gonna deal with the NASDAQ. Okay, we're gonna deal with the NASDAQ. Okay, specifically we're talking about technology stocks. Now what you see in front of you right here is you see XLK. XLK, I believe it's a cornerstone to the whole stock market. I believe it's a steering wheel that moves everything. Okay, so what you see in front of you, as long you see this purple line, this is the 50-week moving average. As long as you're above the 50-week moving average, you're fine. Once we break below the 50-week moving average, things get dicey. There's a good chance you're going to lose a whole lot of money. But you see the 50-week moving average, see it rolled over, see it curved over. You see it curved over. Now what's happening here is you got a little fake out right here and then came back down. Then it couldn't break it right here. Came on down. Now we right here at the line again. You see, this is a critical area right now. Very critical. A lot of people have enjoyed this little move up we had for this short, brief little time. This could be a wake up the bear time. You see, just when everybody's coming out to play, the bear wakes up. If you get caught with this bear again, it can really do damage to you psychologically wise. So that's why I'm doing this video. This video is for everybody. Watch this video. Now, what I'm doing specifically now, I'm buying some insurance on my portfolio. That's the best thing to do right now, is to buy some insurance. Now, what we do here on this channel, we implement something called the cross method. Now, the cross method works like this. Your north and your south, it responds when the stock market goes up. The east and the west responds when the stock market goes down. So right now, we had this good little run for a couple of weeks. So what that means is that to buy insurance for your portfolio is dirt cheap. Pick up some insurance for your portfolio. Please do that. And even if things work out and the stock market keep moving up, you bought the insurance so low that you're going to be glad that you got it in there. You'll sleep better at night. Okay? So I'm doing this video and hope you watch these videos. And this video is very timely, time sensitive. Now I'm back now. So what that means is I'm going to start producing these videos 3 times a week. Okay? I like to do these things maybe like on a Tuesday, Wednesday, and a Saturday. Tuesdays, Wednesdays, and Saturdays. That works for me. Now, if you got any particular issues, stocks you want me to look up, things like that, check out your portfolio, give me a holler down there below, and I will. If I find a stock that's better than the stock you have, I'll give it to you so your portfolio be the better for it. Remember, on this channel, we buy the best. You let somebody else buy the rest. I'll see you on the next one.